So good afternoon once again. It's a pleasure once again to welcome you to this event. It's my great pleasure to introduce our distinguished guests, and I will turn to that in one moment. First, I just want to acknowledge the support of the many sponsors of this event. First of all, the Cultural Services of France, also the Social Exclusion and Inclusion Study Group, of which I'm one of the co-chairs along with Michelle Lamont and also Hilary Silver. Here. The Seminar on State and Capitalism since 1800 is also a sponsor of today's event, along with the Seminar on French Politics, Culture, and Society. So we're all very happy to see you all here. I will try to keep this brief, although the accomplishments of our two guests make it very difficult to make a brief introduction, but I'll do the best I can. Maybe I'll just speed up my speech.
I was late, you can skip it.
I can skip it. Thomas Piketty.
Inequality, that's what.
Thomas Piketty joins us from Paris. He earned his PhD in 1993 from the School of Advanced Studies in the Social Sciences, as well as the London School of Economics. This is something of a welcome back to Cambridge. I suspect one of many visits back to Cambridge over the years since he left MIT in 1995 to take on numerous research fellowships in Paris. As of 2000, he's professor of economics at the School of Advanced Studies in the Social Sciences, as well as the Paris School of Economics. He's the author of 9 books, 20 articles in English, 15 articles in French. He's been absolutely a prolific scholar, and he has what can really be characterized as a truly globe-spanning research agenda on income inequality, particularly on the evolution of top incomes. Some of his best-known work is on that topic. But he's also written quite widely and interestingly on inheritance, redistribution, voting, and fiscal policy. So we're quite happy to have you here. Welcome. Sandy, I'm not going to skip you entirely. We're very, very fortunate indeed to have Sandy Jencks with us today. Sandy is the Malcolm Weiner Professor of Social Policy at the Harvard Kennedy School. He's had a wide array of appointments and fellowships over his distinguished career, including appointments at Northwestern University, University of California, Santa Barbara, University of Chicago, along with Harvard. He's also been a fellow at the Center for Advanced Study in the Behavioral Sciences, the Institute for Advanced Study at Princeton, and the Russell Sage Foundation. Among his many honors are elections to the National Academy of Sciences, the National Academy of Education, the American Academy of Arts and Sciences, and among his many awards are the ASA Best Book Award for his well-known work Inequality, and also one of the especially interesting awards that he's won is the Harvard Graduate Student Council's Excellence in Mentoring Award. And I think Sandy truly has set some sort of a global record for support of young scholars in the social sciences, so that's very well deserved. His 8 books include the classic works Inequality, Who Gets Ahead, and also The Academic Revolution. He's published too many chapters and articles to count. And one of the distinguishing features of Sandy's work is that he's also published essays in many high visibility outlets such as the New York Review of Books, the New Republic, Daedalus, and the American Prospect. So with that, I will turn over the floor to Professor Piketty and Sandy, but once again, welcome, gentlemen.
Okay, so thanks a lot for inviting me, and sorry about my bad French accent, but as you see, I have spent time teaching in Cambridge, but I still, I still speak English like I speak French, and sorry about that. So this is a big title, Inequality and Capitalism in the long run, and what I have to say is much more modest because I know very little about this issue. I know more than what I knew 15 years ago when I started working. So I'm going to try to share with you some of the progress I have made in various areas. But let me make clear that this is what I like in this area and in economics in general and in the social sciences in general is that very often we start from very low, so we have a good chance of making progress. Particularly in economics, I should say, so I think I have made progress on this issue, but again, it's not that we know everything. So let me as an introduction, remind you that for a long time, the question of inequality and income and wealth distribution was really at the center of economics. And the bottom line in this introduction is that we should put it back right on the center. For a long time, being an economist, at least in the 19th century, meant trying to think about how the long-run distribution of welfare, the long-run distribution of income and wealth in particular, will look like. And at that time, most economists that were asking the questions would tend to come with apocalyptic answer, in the sense that they could not figure out a long run that was balanced. So what I mean by a balanced growth path or a balanced development path is a growth path where everything is rising at the same rate. So, wages, profits, but also real estate prices, wealth, asset prices, rates of return, everything grows, say, at 2% per year, or 1% or 3% or whatever, but it's balanced in the sense that the distribution, you keep everything, somehow everything is kept under control. Now, many economists at that time, either Ricardo or Marx, when they were thinking about the issue, they would always come with a more or less apocalyptic answer, in the sense that a small group in society, so it will be landowners in the case of Ricardo, or capitalists in the case of Marx, according to them, were sort of capturing an ever-growing share of income and wealth, and basically, if we let the process goes on, it's gonna end really badly. And the basic mechanism they had in mind, in the case of Ricardo, the idea was that the relative price of land will go up forever. So it's as if, if someone now would say, well, maybe the relative price of real estate, particularly in large cities like Paris or New York, but I guess also in Boston, if the relative price of real estate is going up 5% per year, but income is going up only 1% per year or 2% per year, in the long run you have a problem, and so that was the problem of Ricardo. The problem of Marx was a bit more subtle, in the sense that even if you don't have this big relative price problem, so even if the relative price of assets and consumption goods is right on track in the long run and there's no divergence here, you still can have divergence just in the accumulation process of capital, where basically you accumulate capital forever relative to income, and then either the capital share is going to go to 100% or the rate of return, the famous rate of profit, is going to fall. And in any case, that's going to end up very badly, either in World War I or in some big other catastrophe or some big revolution, but somehow there's no balanced growth path. Then during the 20th century, a much more optimistic consensus emerged, partly for good reason and partly for bad reason. So the good reason for the more optimistic consensus is that when you have growth, when you have positive self-sustained productivity growth in the long run, then the long run, the future looks a bit less apocalyptic than what Ricardo and Marx thought. But the bottom line in this presentation is that, in fact, a world with a small positive growth is not that different from the kind of world with zero growth than Ricardo and Marx were thinking of. That is, you have strong divergent forces which can operate in such a world, and in a way, they were asking the right questions. Maybe they didn't come with the right answer. And, the very optimistic consensus of the 20th century, to a large extent, was based on it was more, in the Cold War context, many people just wanted to believe in balanced growth paths. And, in fact, if you reread, so Kuznets was really the first author to come with a sort of optimistic conclusion about inequality and capitalism in the long run. But if you read Kuznets again, you can see that himself was aware that his optimistic conclusion had a lot to do with shocks due to the war, which had in effect reduced the inequality of wealth in particular, with a very simple mechanism, is that when you destroy wealth, you reduce inequality. But of course, that's not a permanent mechanism, unless you have periodic wars. But it's not going to. it does not apply permanently. And Kuznets was very much aware that there was nothing really natural in the process of reduce inequality. So just to remind you, Kuznets worked with data that covered the United States, and he was the first economist to produce income inequality series for a reasonably long period of time, which was between 1913 and 1948 for the United States. So he had one country, a large country, the US, over a 35-year period. So it was not a lot, but it was much more than what everybody had before him, you know, because people had been talking forever about the long-run trends in distribution, but there was just very little data. You know, Marx and Ricardo were really heroic people, you know, because they were trying to predict the future of the universe on the basis of really little data. Basically, you know, Marx was trying to use what we knew about industrial profit in the UK in the 1840s and 50s, and he was just observing that industrial profits were rising much faster than wages, and he was trying to predict the long run from this. And, you know, he did what he could. You know, he had limited data. So at least with Kuznets, for the first time, there's more data. There's one country for 35 years. So as I will show you now, we have much more data. So we know more, at least than this. And we can see that, in fact, the more optimistic consensus that emerged from Kuznets is certainly over-optimistic. In particular, maybe the first important fact that I will that emerges from my research, and that maybe some of you have heard about that, is that you know, since the 70s, in particular in the United States, you've had this very strong reversal of the trend. So Kuznets between 1913 and 1948 witnessed a reduction in inequality. But over the 30 years before the financial crisis, you had a huge rise of inequality, particularly in the US, with over 50% of total growth. In fact, almost 60% of aggregate US economic growth going to the top 1% of the distribution, which clearly doesn't look like a balanced growth path, okay? Because if you pursue that in the longer run, you have you know, the future looks gloom. So the bottom line is, you know, 19th century economists raised the right questions. We need to address this question again. You know, we have no strong theoretical or empirical basis to believe in balanced development paths. And of course, the recent financial crisis raised also strong doubt about this. You know, you just need to replace the price of land that Ricardo was very worried about by the real estate price or the oil price, of course, and you have you look at the trend over the past 20, 30 years, and if you try to predict the long run, you have a problem. Okay, so I'm going to talk. So sorry that I'm going to talk mostly about my own research, but you know, I don't pretend that you know, we solve everything with this research. It's just that, you know, this is a research that I know a bit better than others, and you know, so I'm going to try to talk about three points, but you know, I'm not sure I will get to the third one. So maybe I will concentrate on the first two. So I will first talk about the rise of top labor income, particularly in the US, and I will follow a recent survey that we wrote with Tony Atkinson and Emmanuel Saez, based on our world top income database that we've been collecting. Then I will talk about another related issue, which is the long-run evolution of inheritance. And maybe you know, that's not going to be a theoretical you know, presentation, but there's one sort of analytical / theoretical mechanism that I would like to emphasize, is this R bigger than G mechanism, where R is the rate of return to wealth. You know, how much total income, including capital gains, do you get from your wealth each year, as compared to the growth rate. And I will argue that, you know, it's sort of unavoidable that when R is bigger than G, you have very strong divergent forces in the long run, and in particular, inheritance becomes really big. And the basic intuition is simply that wealth coming from the past is being capitalized faster than growth, and somehow it's eating up the future. You know, it's sort of dominating the new wealth coming from from labor. And I think this poses a serious threat to the kind of meritocratic ideal and meritocratic values which we all cherish. And this is, in a way, I think one of the reasons why the 19th century economists were so concerned about the long run is that in their view, the growth rate was structurally very small. Maybe, in fact, in the pure Marxist model, it was zero because all growth came from capital accumulation and there was no long-run productivity growth. And so it was obvious, well, in the 19th century anyway, observed growth was so small, maybe 1% per year or even less, then it was obvious that the rate of return, even if it's 4 or 5%, is bigger than the growth rate. And today, we sort of come back to the same world, at least in the developed world. Of course, the developing world is converging towards the developed world is growing much faster. But once you are at the world frontier, we have no example of a country at the world technological frontier growing at 4 or 5% per year. It's always sort of 1 or 2%, and it's unclear whether we can do much about it. And but then this has implication about the dynamics of inheritance versus labor income, and this is what I was saying about the fact that real estate prices are rising much faster than labor income. It's sort of unavoidable in this kind of equilibrium, and that's a bit disturbing and problematic politically. And so anyway, that's I have no particular taste for apocalyptic prediction, I should say, but there are some mechanisms which produce maybe not apocalyptic conclusion, but at least rather gloom conclusion. The good news is that there are some ways out, in particular in terms of tax policy, because one way to bring R closer to G, of course, is to tax capital and capital income, but that's not easy to do in a world with a lot of tax competition between small countries as compared to the size of the market, but that's another political science issue which we will not really talk about today. Okay, so let me start with the first issue and this top income project. So, we've been collecting. So basically, I'm going to try to summarize very quickly what we've learned from this large collective research project. So, as I said before, you need data to talk about long-run trends in distribution, and so here. What we've been doing is basically the same thing as Kuznets, except that instead of having one country for 35 years, we have 23 countries over a century. But we are sort of using the same kind of data source and method, which combines national income accounts with income tax return data. So in most of our countries, our series start around 1914 simply because the income tax was created around that time in most countries. So as you probably know, the federal income tax in the US was created in 1913. In France, it was 1914. In the UK, it was 1909, and in some countries, it was in the early 20s. And before that, of course, you have no income data. Okay, so like in most countries, the tax system in the 19th century does not produce data on income; it produces data on wealth, because you do have inheritance tax, and I will talk about this data later. But on income, you cannot really study the 19th century, unfortunately. So there are two main findings in this project. One is the fall of top capital incomes, which was really a shock, as I said already before, a war shock phenomenon. So, for the most part, this is the very strong physical but also political shock that were incurred by wealth holders during that period that explains this reduction of inequality. And then in the most recent period, particularly in Anglo-Saxon countries, we have a huge rise of top labor incomes, although of course top capital incomes are also recovering, but this is a slower process. So let me try to, I'm just, sorry for the advertisement to my own book, but basically I'm going to try to summarize two very big books, each is 800 pages long, and so the green one was published in 2007, the blue one in 2010, and the green one covers basically you know, the US, the UK, France, Germany, well, there are over 10 countries, and the blue, so all the usual countries, usual sort of core OECD countries, and in the blue one, we have more other parts of the world. So we have countries from South America, we have countries from Asia, we have India, we have China, we have Indonesia. We also have some Southern European countries, some Northern European countries, so there are 10 other countries in the second volume. And I should say all the data is available online on this website, so you know, that's called the World Top Income Database, and that's hosted at the Paris School of Economics. And so we've put together, and we update all the data. There is new data. So the red countries are the countries which are already in the database, and the blue countries are countries which are currently being. So when we mean doing a country means that we take basically all the income tax data since the creation of the income tax in this country. So that's usually 1 century ago, about 1 century ago. But that's quite a lot of work, because this requires not only collecting all the income tax statistics, but also the income tax law, because you cannot properly use the statistics, of course, if you don't know very well the law and how it was applied. So it's quite a lot of work. I mean, there are over 25 scholars that have been involved in this project. So of course, I didn't, you know, I did a few countries myself, but I didn't do all countries myself. That's really a collective project. So one of the most spectacular graphs coming from this project was this US graph, which you may have seen, where, you know, the top, so this is the share of national income in the US going to the top 10% of the distribution. And as you can see, in 2007, we have the highest recorded level, except 1928 at the eve of the financial crisis. So, of course, many people, by looking at this graph, said, well, you know, maybe there is a relationship with the crisis. You know, maybe the fact that inequality was going up was rising, growing so fast in the 80s and 90s and 2000 has something to do with the crisis. You know, but my own view is that modern, you know, today's financial systems are sufficiently fragile to crash by themselves. You know, even if you don't have a rise in inequality, they can easily crash. Now, the fact that you have a rise in inequality puts some extra pressure on the financial system. You know, in the sense that you have some people at the top who have an extra 15% of national income, and probably we're not going to consume all of it. And you have the bottom 90% who has a stagnant income, you know, basically, because if the top, you know, the reason, you know, I care more about the bottom than the top. So the reason I care about the top is that, of course, the share of national income going to the bottom has been going down from 50% from 65% to 50%, and this means that you've had income growth basically. You know, if you take away, one way to see that is this. You know, if you take away the fraction of total U.S. growth going to the top 1%, you have to take away 58% of the growth. So, you know, per capita growth was already quite small, 1.2%, but if you take away the top 1% growth, you get to 0.6%, which is really very little, you know, especially if you have rising real estate prices. In fact, that someone who doesn't own, who is reimbursing a loan to own your apartment, you actually have a declining income. So maybe what you do in the short run is to accumulate more debt. You know, especially if you have a financial system that's pushing you to borrow because there's all this extra income coming from the top, which you have to invest somewhere. So you know, I think this probably did contribute. You know, many people now agree that this probably did contribute to make the overall financial system more fragile. At least this put a lot of pressure on the financial system when you have this kind of big distributional shift. This puts a lot of pressure on the system, and this probably contributed to the crisis. So this is the top 10% taken as a rule. If you decompose this top 10% into 3 groups, and here we put the income threshold so that everyone can locate his own income. So basically, so this is family income. So to be in the top 10%, you need to be, so in 2007, you need to be above $100,000, and to be in the top 1%, you need to be above $400,000. So as you can see, so you know, the top So the people in the middle, the triangle, would be my fellow Harvard economists, and as you can see, they have done pretty well. I mean, I don't know about wages in the sociology department, but they are probably a bit lower, but maybe not that much. I don't know. Anyway, my fellow economists, you can see that they have done pretty well. So, and I think this has an influence on their view of the U.S. economy. You know, they feel that the economy is sort of rewarding a marginal product in an efficient way. Now, I think this, you know, it would be surprising if these are the only agents for which, you know, this kind of economic fact has no impact on their view of the world. And but in the end, you know, the people above them have done much better. You know, as you can see, you know, the people above $400,000. You know, of course, you have some variation. You know, you can see, for instance, in 2000, this is the explosion of the internet bubble. So, of course, in 2001, 2002, there's very little capital gain, very little stock option, very little bonus. But then in 2003, 2004, this starts increasing again. And we have now the data for 2008, 9, 10, and actually the same is happening. That in 2008 and 9, of course, this has declined a little bit, but then in 2010, this starts increasing again already. So per se, financial crises do not change the long-run trend, or at least, you know, there's little evidence to be that optimistic. So I cannot show you all countries, but you can see that. So here, these are English-speaking countries, where in general you have the same trend as in the US, but less pronounced. Okay, so the US is always the country where it is the more pronounced. Now, if you take continental Europe, so I still don't understand why continental Europe became Middle Europe. I think this is due to my co-author, Emmanuel Saez, I don't know, from California. He thought that continental Europe. Anyway, that's what we mean by Middle Europe is really continental Europe, but. And you can see that for continental Europe and Japan, you don't really have the upward trend at the end. Well, in fact, you have if you update the data until 2007, 8 in every country, you will see an upward trend, but this will be much less pronounced than in Anglo-Saxon country. Which also means that, you know, it's very hard to account for this on the basis of pure technological economic forces. You know, in particular, the usual explanation put forward by economists based on you know, skill bias, technical change, or superstar market, or, you know, the fact that basically the productivity of the very top of the distribution has risen a lot, and basically this is why, you know, the market price for high skills maybe was distorted downwards because of social norms in the US until the 70s, and now people at the top are really paid their marginal product. And this is, you know, if that was the case, you know, this should have happened more or less everywhere. You know, the fact that this happened only in some countries and not in others, you know, suggests that, you know, this is really a very naive view of the top-end labor market. And, you know, if we really look at the evidence, you know, I think it's more realistic to imagine that at least to some extent, you know, some kind of grabbing hand model is working. That is, you know, if you don't know, you know, this view that wages have to be equal to the marginal product of an individual, which is what the textbook economic model is telling you, is sort of okay if you take jobs which can be replicated, like if you have you know, 200 people which do exactly the same things, then you can see when you add one more worker on a factory line or one more worker at the McDonald's, you can sort of see what's the extra marginal product, and maybe the wage is not exactly going to be equal to this, but it cannot be too far away from there. Now, when you think of, you know, top corporate jobs, you know, it's not that you're going to run the company for 10 years without a chief financial advisor or without a you know, top executive, and so there's no way you can measure the marginal product. So the way it's going to work is, you know, it's typically you set up a committee, you put people in the committee to decide how much you should be paid. The external committee is going to take the average of how much people are paid in other firms, and is going to increase the average of other firms by 20% so that everybody is happy. And of course, with this kind of process, you know, you have basically, you know, when at least our favored explanation, and we have a recent paper on this, with Emmanuel, is that, you know, when pay setters set their own pay, basically there's no limit, you know, and what happened really in the US is also that, and to some extent in the UK, is that these are the countries which had, you know, the highest drop, the largest drop in top income rate since the 60s and 70s, and probably this changed completely the name of the game in terms of high pay setting, okay, which, you know, it's important to have in mind that in particular in the US, during half a century, between 1932 and 1980, on average, you know, the top tax rate, well, a very large income, but, you know, this is what we are talking about, was 82% on average, and that's not including the state level income tax. That's only the federal top tax rate. This has varied, you know, sometimes it was 91, sometimes it was 70%, but on average over this 48-year-old period, almost half a century, it was 82%. And of course, when it was 82%, you know, if you want to get paid $1 million more, you know, 82% of it is going to go straight to the treasury, and so that's going to be hard to convince your subordinates and your shareholders that it's worth it. You know, whereas when the top rate is 28% or 35%, as it is right now, then you have strong incentives to convince everybody that you are worth one extra million. So at least this mechanism is at least as plausible as the other one and can account for the diversity across countries of what has been going on. So now let me come to the second issue. You know, I guess I should speed up. For how long I have been talking? I didn't really follow. I'm sorry.
25 minutes.
I've
been talking.
I've been talking 25 minutes, 10, 15 minutes. Okay. So let me come now to the second big issue I would like to talk about, which is not about the working rich and top labor income and CEOs, etc. And it's more about it's about inheritance. Okay. And the key question, you know, the beginning of this research project on inheritance was really like many research projects by reading novels and, you know, by reading Balzac and Jane Austen, and I was obsessed by the question, you know, in the 19th century, inheritance was really big. I mean, it was not only in the imagination of Balzac, it was also in, I mean, it's not only that Balzac himself had a lot of financial debt and was trying to, you know, write so many novels to repay his debt. I mean, certainly he was obsessed with that personally, but it was a more general phenomenon that inheritance was everywhere. Again, not only in the literature, but also in the actual tax data, in the sense that the good thing with France, at least, is that we have very good, actually, inheritance data starting in the 19th century, because the French Revolution created a pretty universal inheritance tax, universal in the sense that everybody at death. So this was created in 1791, so very early in the French Revolution. That was part, you know, shortly after the abolition of the privileges of the aristocracy. They created this pretty universal inheritance tax, universal in the sense that everybody had to file a tax return when you die. Well, your children have to file the tax return after you die. And everybody, even if you're very poor, and, you know, even if you're very rich, even if you're in the aristocracy, of course, everybody. And also it applies to all assets. So it's both to real estate assets, to financial assets, and you have to report everything. Now, in the UK and the US, you have to wait one more century to get something similar. So in the US, you have to wait actually 1916 to get a federal estate tax. So before that, you have state estate taxes, but it varies between states. It doesn't treat real estate property and financial property the same way. So basically, you have no data source. And in the UK, you have to wait until the 1890s to have a tax treating real estate and financial wealth in a similar way. Otherwise, you don't have the data source. So at least in France, we can study this, and we can see that at the time of Balzac, you know, the annual flow of inheritance was indeed huge. Okay, so every year, year after year, the mass of wealth that was transmitted was extremely large, as compared, for instance, to the total mass of labor income. So this is a simple ratio, you know, that I've been trying to understand the evolution of this. What are the theoretical forces, and in practice, what do we observe in terms of evolution of this ratio? And what I find is that, of course, you have had some distributional change. That is, the distribution of wealth has changed over time, and it is a bit less unequal today than it used to be. We have more of a middle class today. Even if the top 10% still has, over 60% of total wealth and over 70% in the US. So wealth is still much more concentrated than income. But there's been some decline in the distribution. But in the end, this is quantitatively less important than the huge change in the aggregate value of inheritance. And basically, there's been a huge decline of the aggregate value of inheritance between 1900, 1910 and 1950, 1960. So basically, in the post-war period, so that's to a large extent due to the war shocks, but it's a bit more complicated. Anyway, in the post-war period, in the 1950s, 1960s, and to some extent in the 1970s, the flow of inheritance, the total value of wealth that gets transmitted is really very small as compared to the Belle Epoque and 1910. And in a way, it lasted for so long that, I think this is the explanation for a sort of very long-lasting human capital illusion, the view that somehow now human capital has replaced, financial capital or real estate capital, and that, what matters is much more, individual skills and individual merit. And I would like this to be true, that would be so much nicer. But unfortunately, this is not true. Again, if you look now at real estate prices, you're going to think I'm obsessed with real estate prices, but, it's a big issue in Paris right now. Not only in Paris, I think, but I think it's a clear example of a divergence. When you can see that income are going up much less fast than wealth, and that's troublesome. And so basically, this is the issue I explore in this paper. So let me summarize very quickly what I get. So first, you can see that in fact here you have on this graph. So it looks a little bit like the US graph we showed before, except that this has nothing to do. Okay, in the US graph, this was about the income distribution. We look at the top 10% of the income distribution and as a fraction of income. Here we look at how much inheritance there is. And the two issues are related, but they are mostly independent, in the sense that you could have a lot of inequality even in a world with no inheritance, and you could have a world with a lot of inheritance with no inequality if everybody was receiving the same inheritance, for instance. So this is largely unrelated. So you can see that in the 50s and 60s there is very little inheritance to receive, whereas if you look at generation born in the 70s, 80s, which I care particularly about, but even more so for the generation born in the 90s and 2000, they will actually receive a lot of inheritance. Well, for some of them who have inheritance, but of course the problem is that inheritance is very unequally distributed. So basically, those who receive it can, it's okay. Those who don't receive it, who only have their labor income, well, basically they pay rent to those who have inherited something, and that's a bit disturbing because this is the kind of inequality which we thought had disappeared, in the post-war period. In the 50s, 60s, 70s, to a large extent, we believed that this has disappeared. So the main lesson from this and the main explanation is this R versus G logic. So I don't want to bother you with technicalities and equation, etc. Just one simple economic mechanism I want to get through is the idea that, if you compute R, the rate of return to capital, which is the total, income flow coming from capital, this includes profits, rents, interest, dividend, capital gains, divided by the wealth. So, for instance, if you have $1 million in wealth and if you have $50,000 in total income and capital gains, that's a 5% return during the year. Now, if the average aggregate return R is bigger than growth, and if you have low growth, so typically assume R is 4-5%, G equal 1-2%, then if this continues forever, or at least, this is basically what has been happening since the 70s. Growth has been about 1-2%, and the average rate of return would be 4-5-6%. It varies over years, but if you sum up over 3-4 decades, that's what you get. Then necessarily the inheritance somehow is bound to dominate new wealth. Okay, so if you're looking for an evil law of capitalism, this is it basically. When R is bigger than G, the past is sort of eating up the future, and that's really disturbing. Or at least this is the conclusion I have come to with this historical study in inheritance, that it's only in countries and time periods with exceptionally high growth rate, like in the 50s, 70s, because you had very large growth rate, or in China today, nobody cares about inheritance, okay? Because when you have growth of 8% or 10% per year, whatever your grandparents were accumulating, is very little as compared to. Then it's the same if you have large demographic growth. If everybody has 10 children, basically you cannot count too much on inheritance, okay? Because everything is going to get divided by 10. So it's the same effect as productivity growth. You have to save. You have to rely on yourself, basically. But once this is small, and even more troublesome in some European countries if this becomes negative, in Italy or Germany, where you're going to have negative population growth. In the extreme case where you have only one children per couple, you get inheritance from both sides, well, or from zero side if your parents are poor, and this creates a huge inequality which we forgot about. So if you, okay, the good news is that, the future depends on policy, in the sense that in principle, what matters is not R, but 1 minus TR. So 1 minus TR is the net of tax rate of return. Of course, you have to take into account various tax, inheritance taxation, corporate taxation, but the basic idea is that, of course, if you reduce the net of tax rate of return, then you can have an impact. But as you can see, this also works in the other way, which is, for instance, if we go, going from 3% to 5% would be equivalent to either, you have a rising global capital share, which is a little bit of what we've had over the past 2 decades. And most importantly, this is what you will get if you have a deepening of tax competition. So, for instance, if you have more tax competition, and in Europe this is a very big issue, and you have no corporate taxation, everybody goes to Ireland and Poland and 0% of corporate tax in the long run, then basically you go from 3 to 4% in net return, and it's unclear whether maybe we always like to believe that things are going to get better, but I think in terms of tax competition, we may not have seen the worst yet, and there's probably more competition to come. Okay, let me just conclude by saying that, this macroeconomic analysis on the value of inheritance has very strong consequences for the social structure. Basically the macro ratio determined with the dominant social class. So sorry for this very, sort of, a bit caricatural analysis, but I really believe that this macro ratio has huge implication. Basically, when you have a very large flow of inheritance, top successors dominate top labor earners, which is typically what you get in the rentier society of the 19th century. Now, cohorts which were born in the 1910s to 1950s, and this is a bit less true for the baby boom cohort born in the 1950s than for the cohorts born in the 1920s and 30s. But as you know, these cohorts have had a strong influence on thinking for a good reason, but sometimes also for bad reason. But anyway, they've had, these people, some of these people at least really believe that what matters now is life cycle wealth accumulation and merit-based accumulation, and that, the young people should just work and save and everything is going to go fine. But except that, they were facing a very particular circumstances where indeed inheritance had more or less disappeared, and the new cohorts are facing a very different system. And to a large extent, the rise of human capital and meritocracy was an illusion, especially if you have a tax system that's almost entirely based on labor and very little on inheritance and capital. Let me elaborate just a little bit on this meritocratic illusion. I think there are two there are two different illusion or quasi-illusion, because some of these ideas were true, but were only partly true, or at least much less true than what we thought at some point. One view, I guess the first mechanism that maybe people had in mind in some point, and you can see that in a number of sociologists, but also economists, is the idea that when you have technical progress is naturally making human capital more important than financial capital and real estate capital. That could be true, but except that in the real world, actually, we observe no long-run decline of capital share in national income, and actually in the past decades, it's mostly the opposite. That is, the share of national income going to human capital, to labor, if you want, is not higher today than what it was a century ago. Okay? And the share going to rent, interest, dividend, capital gains, and the pure capital income is actually not declining. The other mechanism maybe that people have in mind is the life cycle model, which is that somehow now you have wealth is just different. Everybody is a capitalist at different stage of his life. It's just you accumulate when you're young and then you eat up the wealth when you're old. Which again is a very plausible model, except that what we observe in practice is that in fact there's no long-run decline in the inherited wealth share in national wealth, and that we've just seen. So it could have been true. It's just that it is not true. Okay, so I'm not going to talk about this, that will be too long. Just what we do in this paper is basically to use the same kind of ideas, especially regarding R and G, but put them in an international context. And basically we have the same general conclusion that, the market system, the price system has nothing to do with merit, basically. And, you can have completely crazy prices, forever, like the oil price level has nothing to do with merit. You can have an incredibly large oil price for decades, and then economists will tell you, well, okay, it's not that bad. Some countries will accumulate assets on some other countries, but then if you end up with oil countries and Saudi Arabia owning half of Europe, I think this creates political difficulties that maybe you don't see in a pure economic model, but which is a serious problem in practice. And just to take a Greek, say a few words on Greece, clearly the fact that one country has to pay R, so R here is the interest rate that you pay on your public debt. And the point is that, you just need to have, self-fulfilling prophecies for a particular country. The size of public debt in a country like Greece is very small as compared to the size of world financial markets. So basically, you only need to have a few traders in a few banks who decide one morning that Greece is not to pay back is debt, and then you start a self-fulfilling process where the interest rate goes up to 10%, and then Greek has to pay back so much interest payment on its debt that in effect it's not possible anymore to reduce the deficit, and we end up where we are today. Basically what we have seen at the domestic level is also there at the international level in an even more extreme way. So the general conclusion is that a world with a large rate of return and low growth is rather gloom, and if we don't have a lot of tax coordination to get to a better tax system, the future looks really gloom, in the sense that in the long run a world with a low growth rate, which is probably what we have when we are at the world frontier, leads to you have very strong divergent forces. In a way you could say, after all, it's not going to be worse than the 19th century, and it's still better than the Ancien Régime, but what's different, I guess, today is that we have very strong expectation about the sort of merit-based system, and we've really told us so many stories and nice stories about how the world now is more meritocratic that I think it's going to be hard to to come back on to this. And it's even worse today to be poor in a way than a century ago, because everybody tells you that you are responsible for it. Typically people in Greece are supposed to be responsible for their high interest rate. People at the bottom are supposed to be responsible for their low marginal product. And I think in a way this is making the same level of inequality even more difficult to accept. Let me conclude by, this is the true conclusion and the final slide. More efficient markets is not the solution. In a way, the whole point of having more efficient markets is to have a sharper capital versus labor distinction. The whole point of having perfect financial market is that even a very dull successor can get the highest return to wealth. That's the whole point of having an efficient market, is to separate human traits of who owns the wealth with the rate of return to the wealth. So, sometimes people believe that in the modern world, the distinction between capital and labor does not matter anymore, doesn't mean anything. But in fact, it's exactly the opposite. The whole point of having well-developed financial market is to have a complete separation between who owns the wealth and who gets the high return. So that's that's certainly not the solution. And in a way, the more perfect the financial market, and the bigger the gap between R and G. So the solution is not in this direction. And let me stop there.
Well, first I want to apologize to everyone here for making them sit in this room for 25 minutes before I got here. I did have it down as 5:30 instead of 5, but how that came to pass remains a mystery. So, second, let me say I really liked Professor Piketty's presentation today for two reasons. The first is that it estimates the role of inherited wealth in France for the past 190 years, which is something that I think probably nobody in this room, except if there are one or two economists, there may be exceptions, but generally speaking, nobody knew before they came here today. There is a paper in QJE in is it August of 2011, I think, but probably most people in this room are not regular subscribers. In any case, the thing that's striking about those results, to me, is that they don't match the distribution of income trends that Professor Piketty has also published. That is, one of the things that's striking about the French distribution of income is it hasn't changed that much in the last 25 years, unlike the United States, whereas the wealth distributions look as if the person who was writing them was the kind of person who had written the article about the United States instead of the kind of person who wrote the article contrasting France and the United States. That's a big deal because we don't have anything comparable to it as far as I know for other countries. And so for a while at least, if you're a Bayesian like me, your default is, well, if the only country you know about is France, and this is what happened in France, the place you start as your default is every place else must look like France too. Now, of course, that doesn't follow. The probability is not more than 50%, but it's your best bet that it's like France. We know that that's not true about the distribution of income, but we now have no way of knowing whether it's true or not about inherited wealth. So that's something that, at least for a moment, we've learned, and maybe people will get to work with IRS data and show that it's different in the United States, but right now we don't know, as far as I know. I wanted to comment just very briefly about the first part of Professor Piketty's talk because I wanted to say something about the page that I put here, about the distribution of income and his sort of causal argument. He raised the question of whether the rise in inequality caused the crash. I think that's probably a tenuous argument, but I think there's a very strong argument that the both the rise in inequality and the crash were caused by the same thing, namely deregulation. And that once we got the banks and the financial industry in an environment in which nobody was going to intervene to tell them to stop doing something risky, more and more risky things happened. And the setup in these firms is such that the incentives to do risky things are very great because you reap very large short-term rewards, and if the bank goes bust or the hedge fund goes bust, you still leave with a bucket full of money. It's really a terrific line of work. I recommend it. Now, does that mean that people at the top aren't rewarded for skill? Well, this is a dicey question. If you say, what does a hedge fund manager do? Well, he gambles with other people's money. And if he gambles with other people's money successfully, they're very happy. You know, they think he's a genius, at least as long as he keeps winning. And at some point, that stops, usually. But if he doesn't, you know, as long as he's winning, it looks good. Now, whether he's contributing anything to the gross national product or to productivity or to the well-being of the country is a whole other question. But it's definitely a skill. If you asked me to gamble with the money of all the people in this room, I couldn't do as well as most of those hedge fund managers have done. In fact, I know what the rate of return to the money I've saved over the years is. It's all in the Vanguard 500 and things like that, and it's paid about 2% every year. And its asset value has risen just a tad above inflation for the last 20 years. So it's not a very high rate of return for dumbos like me. And I've probably done better than a lot of people I know. So, and that, of course, raises a broader question, which I'm going to come back to in a minute, about R and G. I think I pretty much agree with everything that Thomas said about the trends in the distribution of income and the driving forces in it, except for those two rather minor points. There is one question I'd want to raise, which is, when we talk about meritocracy, there are kind of two definitions that have been out there in the world, and they're really different from each other. One is that meritocracy means that you don't have lots of inheritance of privilege, because in our heads we think, well, the people who inherited their money didn't get it by merit, and the people who inherited their occupations didn't get that by merit either, and so forth. It's a little less true with the occupations sometimes. I mean, they often work quite hard to get through medical school or whatever it was. But the other definition of meritocracy, I mean, that definition of meritocracy only says there's one illegitimate thing that we think is a contrary to meritocracy, and that's inherited advantages. But if it's all random, if it's a lottery, that doesn't show up in the way people talk about meritocracy often. I mean, if you say, well, there were a whole bunch of people who started small businesses out there, and 1,000 of them lost money and 10 of them made a bucket of money. There's no need for strong evidence, if you will, that the 10 who made a lot of money really did a better job than the 1,000 who went bust. As long as it was kind of, as long as it looks like it wasn't their dad who made it happen. I have no stake in the fight about what meritocracy means, but I think every country looks a lot more meritocratic by the standard of it's not your dad than by the standard that it actually is some form of merit that you can measure and establish, because there's a huge amount of stuff that looks, at least to an outsider, pretty much like luck. And having gotten myself in a lot of trouble 50 years ago writing a book that claimed that luck explained a huge amount of variation in income, I'm not going to go through this again, but it still seems to me you've got to figure out what you're going to do with stuff that you can't explain. Okay, now the main reason I liked Professor Piketty's talk was that he's really challenged us to think about the future, and that's not something that academics usually do very much of. There are a whole lot of people known derisively in the academic profession as futurologists who tell us what's going to happen in the future, but the people who make serious efforts to predict the future are relatively few and far between, at least in the parts of the academic social sciences that I live in. And I think this is a hard row to hoe, and he's done a really interesting set of things with it. What I want to do is, since I'm totally unqualified to comment on both the QJE paper and that part of his talk, since I'm not an economic historian, I'm not a macroeconomist, and I think my knowledge of this subject is about equal to that of a medium good undergraduate. I want to raise a bunch of questions that occur to an ill-informed outsider or amateur or whatever you want to call me, rather than see if we can kind of move the discussion along a little. Maybe we would have gotten a better commentator if you'd gotten, oh, I don't know, Nicholas Kaldor or somebody to come do this, but that would be hard because he's dead.
He wouldn't have been quite as lively.
Well, maybe when he was a little younger. In any case, the questions I want to raise really are the following. In the scenario that Thomas discussed, R is lower than G. That is, the rate of return to capital is lower than the growth rate. And, what? I'm sorry, backwards, yes. G is lower than R, and the rate of return is higher than the, yes. Anyway, so the argument that he makes is that there's no reason that that can't persist for a long period of time. On the other hand, then I sensed that he felt that perhaps there was a reason it couldn't persist indefinitely. And that's kind of the question I wanted to push on here. The argument seems akin to me to the argument that I recall reading when I had my brief encounter with Karl Marx as an undergraduate, that the problem with capitalism was going to be that the capitalists would produce more than the workers could consume, more than anybody could consume, because the capitalists would immiserate the workers while producing this mass of stuff that they couldn't afford to buy. And you can make a similar argument about services as well, is that you can, you have to somehow have consumption out there that matches the amount of stuff you want to turn out, and you have to have people with income sufficient to buy whatever it is that's produced. Now, if the rich consumed as large a fraction of their income as the poor, that problem would not be a problem. We could have the 19th century, you know, people could have many, many large houses and many, many servants and many, many fast cars and private planes and all that stuff, you know, butlers and personal assistants and you name it. And if you get that going so that the rich are consuming most of their income, then we don't have this crisis in consumption because the rate of growth in consumption is as high as the rate of growth in the economy as a whole. But that sounds like a fairy tale because we're assuming, I think, that the reason the rich are going to get richer and richer is that they'll reinvest some of the returns so that their capital assets will keep growing as a result of this R that exceeds G. So my first question is just, is this scenario economically viable over the long run? And I don't know whether it is, because I don't even know if I fully understood it, but I'd really like us to talk about this. Or is this something that is in the Marxist scenario, say, does lead to a crisis of capitalism and sort of self-destructs in some way eventually, and that it's just a matter of, you know, time? Now, of course, all those prophecies about how capitalism would self-destruct have gotten a bad reputation during the 20th century, but that doesn't prove that they're wrong in the 21st century. I mean, it's perfectly possible to have lived through a century that was an aberration, and if it turns out that that's the case, I'm very glad I was born in 1936, because I don't think this one is going to be any fun at all if it turns out the way Thomas says. But I think that's a big issue. The other thing that I wanted to comment on is a point that he didn't make today, but does make in some other notes he passed around, which I thought was quite interesting, which was that the rates of return to smart investors have been higher than growth, often by large margins in the United States and elsewhere. He cites the Harvard endowment. You might say we need to factor in the mishaps of the last couple of years, but even so, it's been way better than the rate of growth. And I believe the Abu Dhabi Sovereign Wealth Fund and the Forbes richest some number of people or other all did way better. They also did way better than the market. That is, if you compared Harvard's rate of return to the Standard & Poor rate of return or a balanced ticket of any kind, it was way, way bigger. On the other hand, I'm not sure that I think this tells us anything except that the form of kind of crony capitalism that these people were able to engage in is more lucrative than closing your eyes and buying the S&P 500, which used to be the advice that you were given by lots of learned economists. Some of them were my friends and I followed it. Bad idea. But I don't have enough friends who run hedge funds that I could afford to follow the other tactic, and they wouldn't have let me buy in anyway. You also need to think about, well, what's the rate of return to capital to the people who, instead of being among the richest people in the world, only looked as if they were among the richest people in the world. There were people who put their money with Bernie Madoff, after all, and people who put their money in Bear Stearns and Lehman Brothers, and they didn't do so well. Or the people who put their money in MF Global, who only recently have discovered that a lot of it's missing and probably most of it's gone. Somehow the rate of return has to average out to be the rate of return that everybody gets, and at least if that's indicated by what you got over the last 30 or 40 years in the United States from the stock market or from putting money into sort of standard safe bonds or whatever, it doesn't look so fabulously wonderful. I think, though I may be wrong, that that's probably a more relevant standard in some respects, because there are always transfers within the world of the wealthy from the people who are smart and paying attention, sucking money away from the people who are less smart and not paying as much attention. It's kind of the upward redistribution of wealth is a constant phenomenon, or to put it another way, the number of people who inherit money who still have any when they die is a small percentage of the number who inherit quite a bit. And people are very good at losing money as well as making money. The people who make it make more, and the people who lose it lose more. This is a talent that lots of my friends from Harvard College had. So I'm a little worried about what we should be averaging over when we think about this R. Thanks.
Thank you, Sandy. In the interests of getting our speakers some additional feedback, and also in the interests of giving you all a chance to ask some questions, what I'd like to do, instead of concluding at 6:30, which was the original plan, would be to conclude at 6:45, because we do have a reception upstairs as well where we can continue the conversation. But my sense is that there are several questions kind of on the table that would benefit from being voiced. So what I'd like to do is open the floor, collect a few questions, and then give our speaker a chance to offer some concluding remarks. I think it's hopeless that you'll be able to answer the questions, everything that's put on the table, but maybe some concluding commentary. So, in the back.
Thanks. In following your work from very early on, I was of course drawn to the change in the composition of the top 1% in the source of their income that you had charted, and yet I'm still a little unclear, and it's perhaps difficult because of the nature of the data, the identities of the two classes, if you will, or the two, the social identities of the people in the early part of the period versus the later part of the period. Are they really that different, or is there really just kind of a relabeling or a reclassification? Because when you talk about capital income in the early part of the time series, it sounds to me like people involved in Wall Street. Now, if they are literally rentiers, then of course they're not working in a Wall Street firm. They have somehow acquired securities and they have hit the jackpot, or however they've acquired them. But of course we know that a lot of the people who did own securities then were working on Wall Street, but perhaps the income was just classified as capital income, whereas today it's classified as a bonus or as a stock option or whatever it is, as compensation. But so you have labor income and capital income, but is labor income earned on Wall Street in the finance sector really different from the capital income at the beginning?
Two questions. One is regards Argentina and Brazil. I think you have one of these two countries already built on your map, and they have halved the income gap, or the wealth gap, sorry, between the rich and the poor in the past few years. So I'd like to know from your perspective what happened there. And the second question is about the, it's not fully economic, but you said that France was the first country to use a inheritance tax. And it's also, interestingly enough for me, the first country to get into the demographic transition, and shortly after the revolution. So is there according to you, a relationship between the fact that inheritance was taxed and the fact that coitus interruptus was heavily used in France, in France's countryside very early in the 19th century?
Peter?
Can I ask you to say a little more about what drives the ratio between R and G? In your brief remarks, the thrust of them seemed to me, maybe this is just me, seemed to me to suggest that what's really important here is the rate of growth, and can we get it up, can we get it down? But it seems to me that what drives a model is actually the difference between R and G. And I wonder what affects that. And I would conjecture, for instance, especially since we see this unusual decline in the Trente Glorieuses, the post-war period, I wonder if that isn't driven to some extent by the way in which returns are divided between capital and labor. And therefore, to some extent, the whole thing might be influenced by the strength of trade unions, or more broadly speaking, the power of labor in the in the industrial arena and maybe in the political arena. So does that make any sense from the point of view of how you understand this relationship? If not, can you say a little more about what drives the relationship between R and G other than the rate of G?
I think maybe one more question, and then we'll give you a chance to respond not only to this, but also to the, I know you want to speak about the points that Sandy raised as well. So, Hillary?
I wanted to ask you about the national differences that were in the beginning of your talk. To what extent, you showed that the continental European societies have had less of an increase in the top incomes, and I'm wondering what role the various mixes of taxation play a role in this. It goes a bit to Peter's point about the mix of capital and labor and what is getting taxed. So I wonder if you could talk a little bit about, especially now at a time that capital is so fluid, that it becomes more difficult for governments to tax the financialization of wealth compared to having labor that's sort of stuck in place.
Okay, thanks a lot.
Just three very minor questions. Small issues.
No, thanks a lot for all these questions. I would love to be able to supplement this question, but unfortunately I can't.
These are, these are really very these are the key issues. In particular, thank you to Sandy, which I must say I'm very honored to have your comments, and I admire your work very much. I read your book a long time ago, so it's nice to see you making these very nice comments. And let me try to answer to your two questions, which are really, I think, key questions, and which are not, these questions on R versus G are not pure economic questions. These are, I'm not sure there is any pure economic question, in fact, but this is clearly the example of, this is a general social science question, because behind R and G you have, deep social forces, economic forces, everything gets mixed up. We cannot, these are two important questions to leave them to one discipline, I think. So on a pure logical basis, you ask the question, is it viable in the sort of simplest economic model to have R bigger than G forever? And the answer is from, yes, from a purely logical viewpoint, you have no problem. But of course, this requires the capitalists or the wealth holders not to save too much. So how much exactly do they need to save for this to be viable? Well, it's exactly G divided by R. So, assume you have a return of 5% per year and you have a growth rate of productivity of 1% per year. In order to have a balanced system, well, a very unequal system, but at least balanced, sustainable, is that capitalists should eat up 80% of the return, 4 divided by 5, and they should save 1 divided by 5. Because if they do that, then their wealth will increase exactly at the same rate as national income, and therefore everything is going to be balanced. Now, is that going to happen? Probably not. I'm not going to tell you, I've told you that there are all sorts of reasons why we don't have a balanced growth path, so I'm not going to tell you now that everything is going to be balanced. I think these are determined by different forces, how much people save, and this is going to depend, will people want to consume a lot of domestic services, or will they want to accumulate more assets and more buildings and more, that's this can work, but this can also they can also over-accumulate, in which case R will decline. But let me still insist that the fact that in Marx's view, the reason this couldn't work somehow was that because G, the rate of productivity growth, was assumed to be 0. Now, if it's exactly 0, then it means that whenever you have positive saving in the long run, then you have an infinite capital accumulation in the long run, then R has to go to 0. So this is why, so the reason, so growth makes it viable, if you want. Positive growth makes the long run viable, but still it's a very unequal long run, but it makes it viable. So in a way, it's even worse than what Marx thought, in a way, because it's with positive growth you can have this forever, and just it's a very unequal world, because people who inherit, they can consume most of the returns, they just need to save a little bit. Now in practice there are all sorts of reasons why this kind of wealth-based capitalist development path is highly unstable, which is that the financial system can crash, the returns vary widely across assets, between countries, between individuals. So this is a highly unstable process. Of course, the model where everybody gets the same R, the same rate of return, is really a fairy tale. And in practice, it's a big fight between countries. At some point when the US so far had a big rate of return on its external wealth, because they had Saudi Arabia and China were buying US bonds for free with a 0 return. Maybe that's not going to last forever. We don't know. These are big, and maybe Saudi Arabia was doing that not only for economic reason. Maybe this had something to do with the politics of the place. So I mean, this is a big fight. Who gets what rate of return? This is not the fairy tale where everybody gets the same R, and this is just the marginal product to capital. It's important to have in mind the fairy tale model, just to make sure that this is logically viable. But in practice, you have a lot of shocks. Let me say also a few words about the other questions about, is it only a matter about very rich, high returns, or the one way I interpret your question is it only, you know, very high return? Is it only a matter for top Forbes fortune and Harvard endowment, and do people like me get only 2% and not? Yeah, you know, you know, it depends. If you get you know, I would say even normal people, you know, with you know, a few $100,000 or euros, 500 or 600, you know, typically who had some real estate in their portfolio, got a pretty big return. You know, if you have some real estate, you know, typically the real return is going to be at least 3-4%, because the price of real estate is going to increase at least as much as the consumer price, and very often quite a bit more. And the rent you save is typically at least 3%, 4% of the value. So, you know, 2% is not so good. You know, I don't know. If you look at your total wealth, you know, people who inherit typically, or either who inherit some apartment or house, or who inherit some money which is going to help them by purchase a house or an apartment, which is really what you have today. You know, sometimes we view dowries as something of the past, but in fact, we are in the biggest period where we have inter vivos gift to the children. You know, around age 30 to 40, and I don't know, if you look around you, I'm sure you will find lots of people buying apartments of houses with you know, receiving, you know, 100, 200. 300 or $400,000, and you know, normal people, you know, big group of we're talking about big groups of the population. We are not talking about a few dozen people. We are talking about, you know, 10% of the population, 20% of the population, and still these are big amounts of money, you know, because $400,000 is what a minimum wage worker is making for his entire lifetime in 40 years. So we are talking about big sum of money, and pretty violent inequality between different social groups, because there's not much labor and merit involved, and I think most people have a quite demanding view of meritocracy, and that in particular, you know, random shocks and who gets what capital gains because you had the right asset in the right place. I think most people have a more demanding view of merit. Let me, you know, I was not able to answer to everything. You know, the forces behind R and G, you know, there are different forces involved. You know, the G, you should view it as the rate of new invention in society. It looks as if it's only when you are catching up with other countries, you know, like Europe catching up with the US in the 50s, 60s, 70s, or China, Brazil catching up with the rich countries today, that you have 5 or 6% growth rates. That when you are at the world frontier, the rate of new invention or, you know, change in the structure of output is usually much lower, maybe 1-2%. But, you know, it's largely a construction, you know, a statistical construction also. You know, this is determined by one set of forces. Whereas R, the rate of return, is determined by a completely different set of forces, which is how much people want to consume as opposed to save and accumulate. And, you know, the taste for wealth that people have for wealth is a very complex issue. You know, wealth brings social prestige, security, brings very different things, and people care about these different things. Political forces and the capital, labor, sharing of national income, of course, plays a role. In the purest theoretical model, let me conclude by this, the single reason why actually R needs to be bigger than G in the long run is because if R was smaller than G, then people, according to the textbook model, will borrow indefinitely against future income. You know, if you expect your income to grow at 3% and the interest rate is only 1 or 2%, then people would like to borrow like crazy in order to consume today. Like, you know, I'm not saying I believe that this is the key force, but at least this is a pure economic force that's always pushing toward R bigger than G in textbook economic model. But I think it's more, you know, it could be different. You know, you can imagine civilization, you know, maybe sometime we discover a planet where G is bigger than R and it's 10%. So, you know, it's in a way it's by coincidence. But I think, and this is a conclusion, you know, we should not be, you know, construct the future on the basis of random coincidence. And I think we should try to regulate these dynamics, and we have ways to regulate these dynamics. So let's try to let's try to do it. And I guess I should stop there. And sorry, yes, sorry if I did not fully answer to every question. Okay.